About a month ago, I made a video called Climbing the Wall of Worry, and it was about the S&P 500, and it was in reference to the fact that when the S&P 500 reaches a new all-time high, it can continue doing that multiple times before it tops out and goes into a downtrend. In 2024, it reached a new all-time high 57 times, and then in 2023, it was 0 times. And then prior to that, it had multiple years of new all-time highs. And this is where the wall of worry starts to be something that investors have to climb. Because as the S&P reaches a high multiple, and currently it's at 22x price to earnings ratio, that is starting to show that we're at a toppy period in the market where you start to feel like we're in a bubble. But then if the earnings and the capital expenditure that's going into data centers and AI investments is starting to grow and the guidance for that is continuing to increase, just like Oracle reported, hundreds of billions of contracts for their services. Over 85% of these companies have managed to beat expectations. And then you've got the fiscal policy starting to change as we start to go into a rate cutting cycle. And in two occasions where this has happened after a year of being at the same rate, and you cut in September in 1998 and 2024, the market soared into year end. There's volatility prior to the rate cut, maybe before it rallies into the rate cut and then it sells off after, and then it rallies to the end of the year, or it sells off into the cut and then rallies after into the end of the year. Either way, both of these data points show that the market rallies into the end of the year. In this video, I'm just going to go through some of the data points, some of the graphs that I like to look at, some of the charts that give me a framing for where I believe the market continues to go to the end of the year. When I put the video about the wall of worry as an extremely good opportunity to invest and a good opportunity to position for this period. And I'm still convinced and I'm still extremely invested in the market and will continue to be up until the end of the year. And then I'll monitor the market and monitor these charts to see if things are changing, because it's something that you've got to be able to adapt to. The changes can happen at any point. There can be a macro event, a geopolitical event that can lead to extreme short-term volatility. But when the macro setup is this perfect, you've got innovation starting to be extremely encouraged by the current administration. You've got an easing of the fiscal policy. You've got Treasury starting to stimulate M2 money supply into the economy. And then you've got the ISM that's still under 50, which means that we're still not in expansion territory. Sentiment is subdued. There was a lot of sidelined investors who, from big institutions, didn't manage to catch that April low. And therefore, I'm just very much going to talk in a very raw fashion about where I believe the markets are going. I've got a lot of charts, so let's get straight into them. A classic late cycle economy typically has all the following ingredients. It's got the manufacturing sentiment extreme. Think the ISM above 60. You've got services, sentiment is extreme. You've got home builder, sentiment is extreme. Consumer confidence is high. People leaving their jobs because they just feel so confident about their investments, about the decisions that they've made. Investor sentiment is very bullish. Small business confidence is high. You're willing to take more risks as a smaller enterprise because you don't feel like the economy is going to punish you for these risks. It's going to reward you for taking the risks. And that's where you find these extreme euphoric moments in the markets. Job openings and hiring plans are rising. Wage data and surveys show accelerating pay increases. And then CEO confidence is strong and the capex is booming. None of these indicators have flashed, and therefore we're not even close to what could be perceived in the past as a very clear and very obvious cycle top. And so I would take confidence from knowing that these data points just have not been reached. They take time to mature. And so for them to be really, truly reached, it's going to take time. And therefore, I would say there's not an exact time or date, but this is why people believe that this cycle has just started, that this new business cycle could last up to 6 to 9 months, and some going even further and think that it could last to 2029 because of this AI revolution and these big tech companies investing in this future growth and the productivity and the capitalization that will come from all of these productive units that can be created through AI. It's very different to the tech bubble of 2001, where you have these productive units being able to truly bring real growth to economies, whereas you could just stick .com at the end of your company and get an extremely high multiple for just being able to do that and being perceived as an internet company without actual substance. So let's go through the charts. I'm going to go through these really quickly. The composite US sentiment index is still not peaking. It's still quite subdued and it's still quite low and it's still under zero. This is a really important index, the Financial Global Conditions Index, and it's basically showing that the financial monetary policy is going to start to become more positive over the next 9 months. And then the ISM, which is the Institute for Supply Management, is going to also start to show increasing positive sentiment as well. And that usually means that there's more money in people's pockets, companies feel more confident, the economy is more confident, and therefore risk assets start to really prosper in that environment. I want to look at some of the reasons why we aren't in a toppy market, why there is still room for this market to continue to grow. And I want to focus on the retail investor in these charts. You've got the US new one-family houses total ticking up, which means that there's more houses for sale, which means that there's less purchasing of these properties, which means that, again, the market isn't feeling too confident. The market is extremely subdued in its spending, and it's just not in a position where it can start to take on any high interest rate ticket items like a house. Personal savings rates extremely low, which means that people just don't have money. The retail investor just doesn't have that extra additional cash to be able to take on risk. And that is where stimulus starts to enter into the market. And therefore, there's still room to grow. There's still room for stimulus to really hit the retail investor. Really piqued my interest when I think about like lab-grown diamonds and then the price of real diamonds. It hit its peak in 2012, 2011. And since then, it's just been in a downtrend. And so you kind of think about the items that a retail investor would have considered scarce, would have considered desirable. They're just no longer desirable, and they're going for alternatives. They're looking for that cheaper option. And that lab-grown option where you can get the same exact carat, but for a tenth of the price, is the direction that they're going to go in. And they take less risks and waste less capital because they don't have that capital to waste. And it just really kind of made me think about the sentiment of the changing trends, especially with these items that were once very desired. And then this is just something that I think about when it comes to inflation. And then it also really reflects the fact that the AI innovation sector is starting to continue to boom, and data centers are going to require so much electricity. This is why electricity is the item in the CPI basket that is starting to show inflationary pressure. Electricity is going to become something that you've got to think about, become extremely high demand, and we're going to have to provide more electricity. Therefore, it makes me think about Tesla and how they're going to have these mega packs that's going to be able to store energy and stabilize the grids. And as Elon tries to achieve 1 terawatts of hours, that's going to be able to power America for a year. It's going to be important to be aware of the electricity costs continuing to increase. I want to focus on US spending because it really paints the picture of doesn't matter what the administration that currently occupies the office is, whether it's Democrats or Republicans, it's always the same. When you leave the gold standard and you don't back the money supply, the fiat currency, with anything hard, you can just continue to inflate and debase the ability to have any purchasing power with that fiat currency in the future. And therefore, it just makes me think about having any asset is better than having just fiat, especially over the long term. Every single time the money supply continues to increase into the trillions, and at this point, cumulatively, it's at 22.1 trillion. It doesn't really matter who it is, Trump, Obama, Biden, Clinton, Bush, Reagan, it just is going up like a hockey stick, and that money supply is going to continue to increase. The big, beautiful bill is just going to be extremely inflationary in the future. It's going to debase the currency even more. And so hard assets is the only way to go. It doesn't matter if the tariff revenues are going to bring in money. It's not enough to cover this deficit of nearly 37 trillion. It's not going to move the needle. It will help and it will strengthen the US economy, and it will bring revenue to the US economy, which is good for all companies within the US economy. But at the same time, it's just not going to be enough to really eat away at the deficit that's being created by the ability to print and inflate the currency. So the tariffs are going to do something, but they're not going to really move the needle when it comes to the deficit. I want to look at the job market again, because that's a sector of the economy that is one of the dual mandates for the Federal Reserve. And if the job market is not doing well, they reduce the interest rates to try and stimulate the economy, stimulate businesses, and increase employment. And then they also have inflationary pressures as well, where they try and bring the inflation rate down to 2% across a basket of different items. And therefore, this is going to be something to really be aware of and pay attention to. And you look at the broader impact of the job market, you've got office delinquency rates increasing to all-time highs, more than the financial crisis and the oil bust and the recession, which looks minuscule compared to where it is now. That could be because people are working from home. There's a different type of economy emerging with gig work becoming more demanding and extremely popular. And therefore, you're just going to have an extreme increase in the overheads of these companies being reduced. And why would they take on this office space? But then who's going to pay for this office space? That's going to be put on the Federal Reserve balance sheet. And therefore, it's going to be more stimulus to the economy. US employees on non-farm payrolls, which is anything outside of agriculture, it's just flat. It's not moving anywhere. It's not gone anywhere. It's just basically where it was in 2020, just before COVID. This is a graph that really interests me. It was the labor force participation rate and the N2 money supply velocity, the velocity at which that money is moving. And naturally, as the labor force participation rate starts to trend down, the velocity at which people spend money and take on risk and feel incentivized to purchase and buy those non-discretionary items, it's just going to continue to trend lower because that is just not where the confidence is. If the job force participation rate is trending lower, then the ability to spend extra disposable income is going to also trend lower as well. This is take away all the debt, take away the stimulus. You've got the real GDP versus productivity. And this is, again, just sideways, the same way it was before COVID in 2020. And therefore, the only way to really increase real GDP and productivity is going to be through the innovation. And therefore, that's why I get so excited about the AI sector. We've not grown and we've trended sideways since 2010. And therefore, other than the spike before COVID and then after COVID through real stimulus, it's not trended in a direction that leads to real GDP growth. Until we have these agentic hardware devices that move around, providing real productivity for the economy, and that's humanoid robots. Next is rate cut expectations, and basically just looking at the rest of the year and into 2026. What are the expectations for rate cuts? Sentiment index, and then central banks cutting rates. It's got a 9-month lead, and that shows that central banks are looking to increase their rate cutting, especially into the end of the year and into 2026. And sentiment usually follows the decisions that the central banks make. Globally, as they start to reduce the rate, sentiment increases. Money is easier to borrow, it's easier to access. I like this chart because it's market cut expectations, and the Fed funds rate starts at 4.33, which is where it currently is. And it looks like the expectations are that it goes down to 2.94% by the end of 2026. Doesn't mean that it's going to happen, doesn't mean that these rate cuts are guaranteed and they're locked in place, but the sentiment and the fact that people are forecasting for this to happen means that sentiment follows that direction. And sentiment can lead to speculation in a positive direction, and that can lead to high multiples and high share prices for equities. This chart is when you have in 1998 the rate cut after a whole year of no rate cuts, the market rallied into that rate cut, it sold off after that rate cut, and then it rallied to the year end. The same thing happened last year in 2024. The market sold off into the rate cut, and then it rallied into the year end. Either way, that rate cut led to volatility in the short term, before and after, and then by the end of the year, the market, the index was all higher. And therefore, it's just a really important data point to take the next few months and frame your understanding of where you should be positioned and how you should look at markets, and understanding what could happen and why things could play out a certain way. Could go the opposite way. You've got to be prepared for that. You've got to always understand that there's no guarantee, there's no free lunch in the markets at all. But you also need to realize that when you frame these data points around a decision, it allows you to build conviction, and it allows you to understand why things are happening. And the volatility in the shorter term is always going to be harder to understand. But over the weeks and months that play out, it gives you that confidence and conviction in your decisions. Crude oil is going to have the biggest impact on inflation, from production to every part of the supply chain. And so understanding the oil prices and understanding the fact that if it's suppressed and if it's low, that's going to be good for the overall economy, for industries to be able to plan and to not have to incur too many high costs in transporting their items on that supply chain. Crude oil is deviating from that trend and it's going down. And therefore, the price of oil being low means that inflation will continue to tick lower. When you think about the S&P 500 and its price to crude oil, the S&P 500 continues to go up. And that's a good sign because it shows that the S&P 500, when you measure it against something outside of a currency unit like fiat, dollars, euros, pounds, it's continuing to show strength against a commodity that's a very important and stable barometer for the economy. Crude oil being high means that there's going to be extreme pressure on the economy from prices and inflation. Crude oil being low means that the economy is going to go into a deflationary environment. So understanding how the S&P 500 measures against crude oil, which is very volatile, is positive because you want the S&P 500 price to continue to trend up against crude oil. When the short-term rate is lower than the long-term rate, that's a healthy economy. People aren't as concerned about the upward trajectory of where the growth is going to come from. They're willing to borrow at a lower interest rate in the short term and expect a higher return in the long term. But when that is inverted and you have a higher short-term rate and a lower long-term rate, it shows that people are very concerned about the future inflation impacts and the fact that there's going to be potential recessions. And so the economy starts to contract. When you've got the 2-year, the 10-year, and the 30-year all in line, that shows that there's a very conscious economy of people who just don't understand where we're going. We're going to go up, we're going to go down. We don't know if it's going to be a recession or it's going to be an expansionary time in the markets. And so the yield curve is an extremely important barometer to follow. So looking at the 2-year and the 3-year Treasury yields, that being below zero shows that there's room for expansion. There's room for growth in the economy. The US 10-year yield just broke out of this downward trend line, which to me signals that the investor is extremely concerned about fiat currency. They're concerned about lending to even a sovereign state like the US. They don't feel, even with that AAA rating in their credit, they don't feel comfortable. They're concerned about the future. They're concerned about the currency. They want and demand a higher interest rate. And that just shows that the value of the fiat currency is starting to lose its confidence amongst the consumer. And that's going to lead to hard assets being where people want to put their money because they just do not want to put their money into the US bond anymore. The US 10-year Treasury yield minus the 2-year Treasury yield, the spread on this sloping upwards shows that people are more confident in the short term and they expect a higher demand in the long term. And that shows that the recessionary fears are starting to fade from the market. People are expecting an expansionary market into the future and the potential inflationary pressures in the future compared to the moment today. And so that spread shows a healthy economic expansion into the future. This really prosaic point came from Marty Party. We are seeing a transition from Fed QE to Treasury QE. People have been forced into the short end. Banks are monetizing the deficit, which will lead to a trend upward in liquidity and in parallel with sovereign refinancing at lower rates. Basically, the global easing is starting. Global financial conditions, they lead by 9 months. That's trending higher. It's going to reflect a positive macro environment. I want to focus on the index now and just finish off the S&P 500, understanding that the S&P 500 shows a general trend of all equities. And then if you want to go specifically into a high conviction play, a company that you believe in, that's further on the risk curve, the returns are going to be higher. But if you just want to beat the index, you need to understand where the index is going. And so the S&P 500 in 2024 made 57 all-time highs, are at 2021 at the moment, so it's just made a new all-time high. And if you think about that, that's going to be another 37 new all-time highs from now to the end of the year as we enter into a Fed easing cycle, a monetary easing cycle. And that is in the next 3 months. And so you think about where the S&P 500 could go, and climbing that wall of worry continues as the S&P makes new all-time highs, just like it did last year. 75% of stocks are above the 200-day moving average. So 75% of the stocks in 3 of the 4 cyclical sectors have exceeded their 200-day moving average. So there's a lot of breadth in the participation rate of the growth and the share price expansion within the index. So a lot of companies are doing well. There are now more ETFs than actual US listed companies. And this is really interesting because it shows me that there's so many different ways to make that final product, that final meal. There's so many different ingredients that you can use to make that final product. So focus on the result and forget about all of the other ways to concoct that result. Just focus on the result, focus on the signal, try and understand what it is that you believe is going to perform the best, and just go with that, because there's going to be so many different ways to try and beat the index. You could just buy the index, or you could buy high conviction companies that you believe are going to prosper and profit from a rate sensitive environment. The S&P 500, the forward EPS is guiding higher, which is good for growth. Corporate profits are continuing to reach new all-time highs, which is good for growth. The commodity index is stable at 100. And this is good because companies need to have stability. Think about the financing plans and how do you plan for CapEx when you've got all the volatility of the ingredients and the commodities that you need. You need agriculture, you need energy, you need electricity. You need to be able to source these components, and you want to have stable prices before you start to build out and guide for your earnings going into the next few quarters. So having a stable commodity index is just good for all companies and the economy. This is really interesting. Global equity ETFs shows that Greece, even though its economy isn't great, their ETF is doing well. Their share price in their companies in this ETF is doing well. It's up 65% year to date. And that shows that the economy doesn't reflect the stock market. It doesn't reflect how the economy is doing, how people are doing. People are worried about the economy, and therefore they're investing in the companies, hoping to be able to outperform the real returns of being in that economy. So how could it all be relevant? Understand the opportunities that this presents. If you frame the next 6 to 9 months as being a potential period of growth, with volatility, with the having to revisit your thesis, having to come back and go, I'm not just going to watch this one video and then I'm going to base my entire decade into the future on this one video. I'm going to actually think about what it means now, how I can frame this around my investment decisions for the next 6 to 9 months, and revisit this regularly, every day, every week, depending on how active you are. But for now, my framing of where the markets go and what I use to understand where the markets could go, it comes from all of these data points. I follow them all the time. I look at them, I think about them, I consider them. I might not be able to explain them as well as an actual financial advisor, but for me, it's helped and it's made my decisions a lot clearer, and it's given me signal, and it's given me the ability to be more objective and quantitative, not qualitative. And so I'm just going to finish off with these final 3 points. Bitcoin is an extremely useful decentralized asset. It's got no geopolitical problems. It's got no counterparty risk. It's not in one jurisdiction, one domicile. It can be everywhere. And as a result of that, it's a growth engine that could always be beneficial to a portfolio. And this is MicroStrategy's different bond offerings that they have: Stark, Strife, Stride, and Stretch. And they all give higher yields than a standard 10-year treasury, which is about 4%. It shows that people are starting to believe in the underlying asset that's Bitcoin, because they've got the Bitcoin to collateralize these bonds, and people believe in the collateral that is Bitcoin, and that's a growing trend. The next one is Bitcoin to gold. Again, gold's done well this year, and it's just broken out into new all-time high territory. Bitcoin follows 30 days after. I wanted to finish off with this because it's going to really paint the picture for where AI is going to take inflation and what we're going to need to really think about going into the next 5 years as data centers increase and hyperscalers increase. It took the world 68 years to reach 1 terawatt of solar and just 2 years to double it. And so energy is an area which I really focus on, especially when it comes to peak usage through the day being that 4-hour slot, which is where you need to have energy. And outside of that, it's just wasted. And therefore, with Tesla, they have these mega packs that can store energy, stabilize the grid. They've got an auto bidder technology, which allows the most optimal, efficient placement of that energy in the right place at the right time. And so it's just another opportunity for me to think about when it comes to Tesla. They've got this energy storage and energy deployment company that's just not recognized, and it's starting to become increasingly more vital to the revenues outside of the autos. So it's just something to finish off with. I hope you got some value from this macro video. Hope it wasn't too long. And if you did, and you enjoyed a more raw, just me taking the graphs, the charts, and just talking, and basically less scripted, just more of a kind of raw take on what I believe and what I think. And I'm fully convicted. And I've positioned myself with everything that I've said based on these charts, based on this data. And therefore, this is what I believe. This is what I subscribe to. And so hopefully you got some value from this and it's helped you understand where the market could go in the short term, the next 3 months to the end of the year, just based on the two data points of 1998 and 2024, where the rate cut happened in September and the market surged to the end of the year. But then also over the next 6 to 9 months, we could be entering into an expansionary market with interest rates, fiscal policy easing, ISM expanding above 50 all the way up to 60, and all the different measures of sentiment, from employment sentiment, jobs, people wanting to stay in a job, wanting to leave a job, wanting to use their extra disposable income, the M2 money supply growing and increasing and going into the risk assets. So hope you got some value from this video. If you did, like, comment, subscribe. See you in the next one. Bye.